Welcome to Beaver's Wealth Management's September 2024 edition of Let's Talk Markets. It's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know of anyone who may find this information valuable, please feel free to share it with them. Now, before we begin, I want to take a moment to acknowledge the significance of this day. On this anniversary of 9/11, we honor the memory of those we lost, the bravery of first responders, and the resilience of our nation. Our thoughts are with everyone affected as we continue to move forward together. Now, we've got a great show for everyone joining us today, but before we dive in, I wanted to share some exciting updates with everyone as it relates to Let's Talk Markets. We are actually streamlining this Let's Talk Markets to bring you more concise, information-packed insights in a shorter format, while we're still going to deliver everything that you've come to expect within Let's Talk Markets. But in addition, and this is what I'm really excited about, we're thrilled to introduce our new Between the Bears and the Bulls podcast. And we're going to discuss the pursuit of excellence, business, the economy, and everything in between. We cannot wait for you to join us on this new journey. So for Let's Talk Markets today, what are we going to discuss? Well, we're going to take a quick glance to the past. So what's happened this past month in August in the markets? Then we're going to take a hard look to the present. What are investors continuing to keep an eye out for this month? Now, as we typically do, let's kind of take a look at the way that the market and some of the indices has performed through August. And if you look at it, the course of most indices across the board, it's been an incredibly positive year. We've talked a little bit about this in previous Let's Talk Markets, but this has been the best performing market year in a presidential election year ever. So very surprising considering the volatility that we've had over the course of the last couple of months, but that's just the facts. When you look across the board, it's interesting to see the top three sectors of the economy now. If you look at utilities are up over 21% this year. That's a new one, right? Typically, we had seen a lot of the tech sector and even consumer discretionary sectors seeing the largest increase for the year, but it's actually utilities for 2024. Financials come in second along with consumer staples. The lowest three for this year: consumer discretionary up almost 3%, energy 5%, materials 6%. Still all positive. Every sector of the economy is still positive. Other things to look at as we're going to get to it, but Fed funds rate still at 5.5%. Inflation or core CPI, which we're going to go into a little bit more detail, at 3.2%, and the unemployment rate at 4.2%. So I just like to talk a little bit about those numbers as we keep going through this Let's Talk Markets, just to give you a gauge on kind of where we currently stand. But let's first start off by doing a recap of this past month. August brought a bit of whiplash for investors, right? Markets fell at the beginning of the month, caught in the ripples of an interest rate increase in Japan, disrupting a significant currency trading strategy. And this led to a brief, intense global sell-off. In the US, the incident was aggravated by a weak jobs report, with unemployment rising from 4.1 to 4.3%. Now, that remains historically low, but it's still worth noting. The report brought the US into what they call the SOM rule territory. It's actually a macroeconomic assessment which judges whether the economy is in recession based on unemployment rate increases. Additionally, several disappointing earnings releases created a sense of caution with investors over the health of the consumer, you and me. Raymond James Chief Investment Officer Larry Adam, he actually said, other data has been stronger, and a soft landing still appears to be the most likely outcome for the economy. For instance, retail sales for July were up a healthy 1%, and the consumer price index showed that inflation is being tamed with 3-month core CPI following to an annualized rate of 1.7%. So it actually fell. And as you can see from this graph that we're showing, what's interesting is, yes, we've gotten to a point here where we're close to where those pre-COVID levels were of inflation. Not quite there yet, but you're starting to see that the growth or that decline of inflation is really kind of tapering off. And I think that's the key metric when we look at this graph here. And the stage appears to be set for the Federal Reserve to kick off an easing cycle, which should support broader participation and higher equity markets longer term. Now, towards the end of the month, Federal Reserve Chair Jerome Powell said, "The time has come for the Fed to adjust policy," a much anticipated statement for those expecting interest rate cuts this year. Now, those remarks kicked off an equity market rally, with the S&P 500 ending the month of August up 2.3%, and the Dow Jones Industrial Average hitting an all-time high, believe it or not, in August. An all-time high in August. We just got off of it. So it's interesting how just in the course of a couple weeks, we can see so much volatility that we feel a little bit different about the markets today than what we did in the middle of that all-time high just a few weeks ago. Now, one of the things that I enjoy so much about doing Let's Talk Markets now is Ryan's market fact. And so I want to show you what he came up with for this month. And he's calling it the September effect. September has been the worst month for the U.S. stock market historically, with an average rate of return of negative 1.2%. And this actually goes all the way back to 1928. So that's pretty statistically significant. It is the only month that has seen positive returns less than 50% of the time. Also statistically significant. This kind of blew me away when I saw this. The last 4 Septembers, they have all been negative. September 2023, negative 5%. September 2022, negative 9%. September 2021, down 5%. And going all the way back to that pandemic year, September 2020, down negative 4%. We've actually started off down this year as well in September, with the S&P 500 falling 4% last week. So you ask yourself, why? Why do we constantly see this in September? Well, part of it is seasonal behavioral patterns. Investors often reassess their portfolios after the summer, after they're done with their vacations, leading to increased selling pressure in September. This phenomenon is supported by behavioral finance theories, which suggest that investors tend to react to the post-summer market conditions and prepare for year-end strategies, thus increasing volatility during this period. Kind of interesting. And there's also tax and fiscal considerations as well. So large institutional investors and mutual funds, they often engage in portfolio rebalancing during September, locking in losses or gains to optimize for tax purposes. And so this selling activity leads to downward pressure on stock prices, which contribute to the month's historically negative returns. So I thought that was a really interesting market fact for September. Not necessarily something that I enjoy to see or that we like to see from a market perspective, but something very interesting as we get out of this month and into October. So what are investors talking about for this month? What are we seeing in September? Well, the labor market, it's weakening. The U.S. labor market has weakened to a point where, as suggested, data including a major revision, I don't know if y'all saw this, of jobs reports spanning from April 2023 to March of 2024. The Bureau of Labor Statistics lowered estimates by an 818,000 jobs. That's quite a mistake, a 29% difference from preliminary estimates. Combined with the inflation rate continuing to decelerate, the weaker job numbers made the Fed's path to lowering interest rates much clearer. So that's one of the things that we're thinking about in September. Now, second thing is the S&P 500 rallies, but headwinds continue to remain. The S&P 500 experienced a good rally back in August, up 8% over 8 days. That's pretty good. 1% a day, not bad. Affecting a wide range of stocks while volatility indicators remained low. This was supported by reassuring economic data, namely the third consecutive month of sub 0.2% core CPI increases and the uptick in retail sales. Now, don't forget, headwinds remain. However, August and September are typically the softest months of the year for stocks. So further volatility is to be expected over the course of the next several weeks. Now, an interesting dynamic developing in the S&P 500, and we talked a little bit about this just a few moments ago, is the subtle shift in market leadership. Defensive, interest-sensitive sectors like utilities, real estate, and healthcare are at all new highs, while the semiconductor group is actually down. Another thing that people are talking about, Treasury yields are lower, rate cuts are imminent. So there's kind of two sides of this, right? Positive side is, for those people looking to purchase houses, all right, yields and what you're seeing from an interest rate perspective are starting to come down a little bit. If you're somebody who enjoys the high CD rates or Treasury rates that we've been seeing, understanding that that is decreasing over the course of the next year or so. Treasury yields actually rallied across the curve in August, bringing yields lower. 1 year and 2 year Treasury yields are down 35 basis points or 0.35% and 39 basis points respectively, while the 10-year and the 30-year yields are down 19 bips and 17 bips. So when I talk about bips here, just so that we all kind of know what that means, 50 basis points is 0.5%. 10 basis points is 0.1%. So with some of the language that I'll use, what the Fed has talked about, you kind of have an idea of what basis points mean. And Federal Reserve Chair Powell's statement from Jackson Hole indicated interest rates are coming. We actually expect to see the first one this month, with investors expecting 2 to 3 25 basis point cuts by the end of the year. Next year could deliver more than 200 plus basis point cuts. So remember, 200 basis points means a 2% in cutting of the federal funds rate, bringing the yield curve to what we would consider a more normal upward slope. Also, something that's on a lot of people's minds is tech tension continues to escalate. In its simmering trade conflict with China, the U.S. Congress is tightening control over tech exports, especially semiconductors, and seeking international support, particularly from the Netherlands and Japan. Expectations are high for new rules targeting high-performance memory chips, while the Commerce Department is considering new restrictions on AI memory chips, which could impact major tech companies' ability to sell to China. So we're watching this very closely as something that is on the forefront of the economy and the markets. Also, oil demands remain high. Despite the headwinds that we've seen in China, oil prices are down as the summer driving season comes to an end, prompting OPEC to do what they always do, extend production cuts. Global demand is at a record high in 2024. It's 3% over pre-COVID levels. Now, it's still less than oil producers had hoped for earlier in the year. And there's a couple reasons for this. China, the world's largest oil importer, has become the first major economy where electric vehicles have reached 50% of auto sales. Wow. Meanwhile, neither the conflict in Gaza nor the one in Ukraine has had any meaningful effect on oil supply like a number of predictors had indicated. Another thing that's on the forefront of the economy. Japan's economy actually remains very fragile, where the UK's are showing resilience. To give you an idea, Japan's benchmark index plunged after the Bank of Japan raised interest rates on July 31st, demonstrating how fragile the Japanese economy and financial markets truly are. Now, the market has since rebounded, but the country's economy continues to face significant headwinds, including an aging population and low domestic demand. The Bank of Japan's governor defended the decision to raise interest rates, saying the market turmoil had more to do with concerns about the U.S. economy than Japan's, while the finance minister argued that higher interest rates could be detrimental to the Japanese economy. Now, the UK economy is showing some resilience. with a 0.6% growth in GDP in the second quarter and a strengthened pound sterling. With inflation slightly above its 2.2% target, the Bank of England has already cut interest rates by 25 basis points to 5%. This is the first cut since the start of the pandemic in the UK. However, Finance Minister Rachel Reeves discovered a £22 billion shortfall in next year's budget. That's a pretty big shortfall, which, along with pressure to increase wages in the public sector, could have a negative effect on inflation and economic growth. So it's something that we got to watch very closely as the months progress. Now, what's the bottom line? As we remain in the weakest seasonal period of the year, as we've talked about, investors may expect to see some back and forth trading ahead, just like we've seen the last couple of weeks. Economic data and actions from the Fed will remain key influences to watch. We've navigated through many market cycles over the past few years, and yet the markets have proven their strength. The key takeaway from Beaver's Wealth Management is that navigating these waters successfully means being in the right places with the right strategies. And remember, it's not about timing the market, which we all know is nearly impossible over a consistent period. Instead, it's about having exposure to areas of the market that are poised for growth and feeling confident in your investment strategies. Amidst the noise, having a robust plan that can weather any storm is crucial. And that's why we offer our second opinion service. If you or someone you know could benefit from a second set of eyes on their investments, we'd love to help. Ensuring that you are in a good spot with your investments, it's our top priority, and we're here to support you and those important to you every step of the way. Okay, in conclusion, what did we cover today in our Let's Talk Markets? Well, first of all, we recapped the past month of August, examining what's been happening in the markets. And then we discussed the key market developments that investors are watching so closely as they are expected to shape future market trends. Now, we appreciate you joining us today, and we are truly grateful for each and every one of you. And so, as I've said in the past, if you've enjoyed today's content, we have the replays of Let's Talk Markets, which I'm really excited about, posted in our new YouTube page. So you got to go check it out on YouTube. And the video podcast, which is pretty cool. You get video and audio in Spotify. That's there. So please share with anyone you know who may find this valuable. But what I am incredibly excited about, as I said before, it's our upcoming podcast, which we have coined and termed Between the Bears and the Bulls. And so you got to stay tuned as we plan to release our first episode in just a few weeks. It's going to be a lot of fun. Now, before we sign off, I have a question. Why did the Scarecrow win an award? Because he was outstanding in his field. Enjoy the cooler weather as we close out the summer, and we will see you in October for our next installment of Let's Talk Markets. And don't forget, leave it to Beavers.